Mr. Olajide Mafolabomi is the CEO of UCAD Innovations. UCAD Innovations is a fintech startup in Nigeria that's run over the years and is growing significantly in the marketplace. Mr. Jide comes with over 20 years of experience, a senior business executive, platform strategist in technology, media, and telecommunications. He holds a BSc in engineering from electrical engineering, from the University of Ado-Ekiti. And he has over 20 years post-qualification corporate experience, cutting across the financial services industry, the ICT, an extensive product and program management experience in technology platform design, delivery, and monetization. Jide is an alumnus of the Greenfield School of Management Executive Program and of the Obafemi Awolowo University. He started his career as a software developer with Value Card Financial Services, and then transitioned to Econet Wireless in 2002 as an engineer, software developer. And then he moved on to Celtel in 2004. That's now Airtel, where he was the pioneer product development manager. Then he transitioned again to Etisalat as the head of product development in 2008. And he was promoted as head enterprise solutions and service delivery along the journey up to 2015, when he joined Intel as the general manager, products. He left Intel in 2018 as acting director, marketing strategy, and he promoted, marketing, and strategy. Okay. Currently, he's the co-founder and the CEO of UCAD, and a fintech company, like I said, that provides direct to consumer businesses, to build, scale, and manage their retail networks. Jide also serves as a non-executive director at Telserve Networks. Telserve is a licensed internet service provider that is specialized in deploying private wireless networks and IoT solutions in Nigeria. Jide lives in Lagos, Nigeria, and is happily married with his wife and children. Please join me this evening as I welcome Mr. Jide Mafolabomi. Thank you so much, sir, for making time to speak to us again this evening. We appreciate it.
Thank you very much, Deji. And it's a pleasure seeing everybody or meeting everybody once again. As they say, they only ask you to come back and write an exam if you didn't pass the first one. But I want to believe that the topic was actually, I would say, edifying for a lot of people. And that's why we are back to talk about it a bit more. So Adedeji has done a bit of justice, or he has helped to do a summary again. I actually had planned to do a summary of the first session before we get into the second session. I see he's already done that. So I'm just going to put up my slides, and we'll try to do a lot better today on time. Let me say that fintech is always going to be a very interesting topic, as it were. We can't really cover everything in a single session like this, especially, delineated by time, but, we will do our best and try to actually cover what's important. So let me just jump right into it. I believe everyone can see my screen. So even though Deji had done a bit of a summary, I think I'll just some particular slides that I will use to introduce the topic for today, set the agenda very well. So starting from how fintech has evolved, I mentioned the last time that fintech actually started as an initiative in traditional banking. Traditional banks were trying to transform and start using digital tools to deliver services better. And over the years, in about roughly 30 years, fintech has become an industry on its own that is more or less challenging the existing financial services industry. In fact, it's more or less like a parallel ecosystem. So basically, you can be here on the left, as most of us are, or you can live your life entirely on the right, just basically running your day-to-day life, with fintechs and not having any real interaction with the banks. There are now close to 100 million Nigerians who are in these buckets, and it's getting more and more interesting every day. Then, of course, we talked about the evolution, which I think DG has done quite a bit of justice to. So I'm not going to go into this slide, but basically, this is just tracing the journey from when the new generation bank started in the 1990s, and they came into the market and they started challenging the existing banks using technology as their differentiator. And over time, with the coming of the internet and the coming of the mobile phone, I would say there's no industry that has actually leveraged communications as much as financial services. It's always been the differentiator, the game changer, or the disruptor in the financial services sector. As we get more and more digital, I would say the financial services actually are the biggest adopters in this market, of digital technology. And I think we also talked about what I call the value tiers. So I generally put the fintech industry in this market into 3 buckets. And those 3 buckets are based on where we have seen scale. And what I call scale is actually where we have seen companies who have attained valuation of over $1 billion, as well as turnover of over $100 million a year. So there are some other areas of fintech that are still coming up, but they haven't hit that scale. So in these 3 scales, we are talking in terms of customer numbers, we're talking millions. In terms of volume of transactions processed, you are talking millions of transactions in billions of dollars. In terms of revenues, income, you are talking on a monthly basis, tens of millions of dollars. So there are 3 general areas, the neobanks, the payment processors, and then the retail channel enablers. So today I'm actually going to focus on the neobanks, what they are about, how their model works, and so on and so forth. And we also talked about what makes a fintech a fintech. Generally, it's a technology-driven organization that basically has an exponential scale factor. So, your traditional bank, you grow by opening more and more branches and hiring more and more people. But for fintechs, they don't grow in a linear form, they grow exponentially. So maybe they have a sunk cost investment in technology, and they have a team, usually a small, highly skilled team, and they can use those 2 factors to build a company that will scale from 0 to $1 billion, and then they take the model of experimentation. Basically they put products out there in the market, try a number of things, and then see what sticks and what works. And they basically help their business achieve market fit. And then, of course, in terms of who they sell to, they primarily sell to the financially excluded. And not necessarily, financial exclusion is not necessarily just people who don't have any money or who don't have a bank account. Primarily, fintechs focus on young people who are just coming into the market, as it were, who don't have any established preferences. And more importantly, people who are very early adopters of technology. So for them, it's easy for them to actually take up fintech services. And just to close out on the summary, we're talking about how the fintech market really looks. And I defined it as a red ocean, a green ocean, and a blue ocean. The red ocean, for me, is the segment of the market, or I will say the sector in fintech that has the most competition. So there's not so much differentiation anymore. We will talk about that in a little bit. There's not so much differentiation like in the past. There is a lot of competition. You have a lot of players who have scaled very well, and they are competing fiercely against each other. So obviously, for any new entrant into that sector, you have to be very well prepared, both in terms of strategy, in terms of your funding, in terms of your ability to find market fit and leverage your own, find your own differentiators and compete in the market. You have to really, really be on, you have to be on point, as it were. So it's not really a recommended area for someone who is not already established in the financial services. Of course, you have quite a number of players who are already big in traditional financial services and they want to get into fintech. So they already have natural advantages that they can leverage to compete in these areas. So, but for, people who are people who are doing startup in the real sense of it, I want to start up a fintech, red ocean is probably not the best place for you to go. Now, the green ocean is where there are opportunities. There's also a lot of activities and companies that are scaling there. But the difference between the red ocean and the green ocean is that there's still a lot of markets. So things like e-commerce, as big as Jumia is, as big as Konga is, I'm sure we've all heard of Jumia and Konga. Between the two of them, they don't have 5 million customers. So there's still a very large market for e-commerce. Amazon was supposed to come into Nigeria directly this year. I believe it's still in progress. So maybe by the time they come in directly and they start playing in this market, it might become a red ocean. Then, of course, cross-border payments it's actually shifting from the green to the red. And then, of course, retail offline payments. Something happened earlier this year where we had cash crunch. And, there were some fintechs that took advantage and they were able to ramp up their user base from about 6 million to close to 30 million just because of adoption in the offline retail space. So prior to January, I would say 95% of transactions that were done offline are done with cash. So you want to buy a bottle of Coke today in Nigeria, it's not really optimal for you to pay with your card or to pay with transfer because of the charges. So there's still an opportunity there for whoever is solving in that market. And, there are still opportunities for people to come in there. Then, of course, there's the blue ocean, which is quite experimental. There's a lot of companies coming up there, but as far as Nigeria is concerned, we haven't attained scale in this area yet. We have some companies that are doing well, but when I'm talking about scale, let me put it into context for you. You have the likes of the company that collapsed. If you follow the news in the US, the crypto exchange called FTX that collapsed a few months ago. That company was trading something like $40 billion, which is actually more than, Nigeria's budget. That's what the company was trading. It was a crypto exchange. So we haven't gotten to that level in terms of futuristic fintech technologies, what they call Web3 or the third web. So that's still a very blue ocean. And then you take an R&D view. For those who are interested or who have the capacity to experiment, do research, then this is the area for you. So that's the summary in essence. That's where we are. So let's now get into the discussion for today. Like I said, I want to talk about neobanks. That is one category that is quite interesting. I believe we all know what neobanks are really. All of us are. We all live here in Nigeria. We know about Kuda. We know about Carbon. We know about Fair Money. We know about all these guys. But my job here this evening is to put what they do into the right perspective for you. So neobanks are actually not banks. They are technology companies that offer banking service. Technology is actually what they sell, but they adapt technology to banking service and make it simple for you, as opposed to banks using technology to offer their services. That being said, if you use maybe, I don't know, First Bank or GT Bank or Access Bank or Zenith, they all have bank apps. You want to ask yourself, what's the difference between these banks and a Kuda Bank or a Fair Money? We will get into all of that. We'll get into that this evening. Another thing that you have to think about for neobanks, contrary to what most people think, you actually don't need a license to start a neobank. You don't require a license. You can be in partnership with a licensed institution and they actually become more or less your bank. So they provide the traditional banking service that is underlining your offering in the market. So you can start a new bank without actually having a banking license. In fact, most of the very well-skilled neobanks didn't start, at least here in Nigeria, they didn't actually start with a license. They started in partnership with a licensed entity that was operating traditional banking services. And they leveraged the capabilities of that bank to now offer their own digital services to find fit in the market. And over time, they now moved into the license space. We'll also talk about that. Now, one other thing that you need to know about neobanks is that they offer something that we call the zero-touch model to its customers. What zero-touch means is there's no interaction between you and any employee of the bank to provide any service. For many of us up till now, you want to do things like, I want to request for a new card. I probably have to go to a bank branch or call my account officer or, send an email to somebody. There's always, even sending an email, even though it's digital, it's actually not zero touch. Zero touch means you can originate the request and complete it yourself. And the neobank has provided the tools for you to do that. So you can consume any of their services without having to speak to anyone. That is the real selling point of any neobank. Now, again, just to expatiate a bit more about the differences between a traditional bank and a neobank. So a traditional bank always has a physical establishment, an office, branches, and so on. And that is their service platform. So typically everything starts from the branch. Even the bank's operating model is centered around the branch. However, for neobanks, it's purely digital services, web and mobile, and also in the case of Nigeria, USSD. In terms of when did they get into the market, banks have been around forever, over 100 years or more, while neobanks is really just in the last decade, a very recent, very, very recent development in the market. In terms of customer relations or client relations, it is always a long-term relationship with the traditional banks. So basically for you as an individual bank customer, you probably will get value over a longer period of time. So what I mean is, for my company, we open accounts with banks all the time. And I see that it's more or less the same process. We fill forms, we submit forms, and then we go through a process of reference checks, establishing a relationship with the account officer. It might take us a month or some few weeks before the account is opened. But for the neobanks, you open the account right at your desk in a few minutes and you are live for whatever service that you want to use. So it's really geared towards you getting short-term satisfaction, unlike the traditional banks that are heavy on process, and it takes time for them to fulfill customer requests. Then, of course, that ties to customer support. Customer support on the neobank side is purely online, or you can call someone at the best. For the traditional banks, you can summon your account officer to your office, to resolve some issues. That doesn't happen for the neobanks. In terms of the traditional banks, because of the multiple levels of touch to deliver service, it also leads to a much more expensive banking service. So basically, banks charge you for everything. I want to get my statement, I'm charged. I want to get a new card, I'm charged. I want to get a new token, I'm charged. I'm always charged for all the services. However, on the neobank side, it's usually much lower. So to start with, to entice me to join their bank, they typically offer me a bundle that contains a lot of free services that a traditional bank would have charged me for. That's always the hallmark of any new bank, And then, of course, on the issue of license, a traditional bank must be fully regulated as a deposit-taking bank, by the regulatory institution in that country. In Nigeria's case, the central bank. In the case of neobanks actually, in many cases, they start with no license. They basically go into partnership with an existing bank, and they how do I put it? They start the service and then they face the customers. They face the customers and they provide the service, even though the deposits and the fundamentals of the banking service is coming from a bank, but the entire customer experience and the customer interaction is controlled by them. And in terms of offices, of course, neobanks typically don't have offices. They don't have bank branches. Everything is online. And then, of course, for any service, customer vetting, confirmation, it always takes time with the traditional bank, but for neobanks, it's instant. Now, of course, this is just for the next slide. This is just basically reinforcing what we just discussed. Typical banks always require you to either fill a physical form or visit a bank branch to do basic things like opening a bank account, depositing funds into your account, sending money to somebody, receiving money, apply for loans, sign up for savings and investments. Traditional banks in Nigeria have actually done a good job with a number of these things, but there is always a barrier when you want to extend the service. So typically, virtually every traditional bank in Nigeria now allows you to open some certain types of accounts online. But when you want to upgrade or you want to request additional service, they will probably tell you that you need to visit a branch. I mean, recently, one of the tier 1 banks in Nigeria that my mother uses. My mother is in her 80s, and she needed to link her bank accounts on her mobile app, and we were not able to do it. Basically, they wrote her an email saying you have to visit, you have to visit a branch. And she forwarded me the mail. I wrote to them back that this person is over 80 and a little bit mobility challenged. Your branch doesn't have accessibility. She has to climb stairs. So are you telling me that she cannot link her account or our other account to our banking app without visiting somebody? What's the person going to do? Those are some of the challenges you have with traditional banks. But the problem is actually because of people and process. It's difficult for traditional banks to break process. They are heavily regulated, and there's always a consequence for regulatory failure. So they have a very active risk department, and they take much less risks. But for the neobanks, I'm not saying that the neobanks are, they are cowboys. That's not the case. But the neobanks, to mitigate risk, they use systems. They don't use people. So basically processes like that, where there are checks, where there are balances, they automate it rather than, using human beings for it. Now, let's talk about a little bit of what I like to call unit economics, right? So traditional banks, there's a little bit of, I don't want to call it table shaking, but let me say traditional banks actually don't necessarily care about customer numbers. What they focus on is turning over money and earning income from that money. And basically, on their balance sheets, they look at income from money and against costs of providing, or let me say cost of mobilizing that money. That is basically a traditional banking model. So for banks, it doesn't really matter whether they have, for traditional banks, I mean, it doesn't really matter if they have 10 million customers, 5 million customers, or 1 million customers. They focus more on what those customers are turning over. So that's why you find that if you look at any of the traditional banks' annual reports in Nigeria, you will see that for most of them, the corporate and institutional business is always 50% or more on their balance sheets. It's only recently that you now begin to see an aggressive push into retail for those banks. So basically what they look at is there's Alaba market, there's business, or let's say maybe there's Onisha market, there's business there. Let's put a branch there and let's put people there and let these people mobilize deposits and facilitate transactions. And based on that, we make money. And with that deposit income or savings income or whatever type of income, how we make money on those deposits and other transactions they do, we now look at that against the cost of operating that branch. And that's what determines whether the branch is profitable or it's not profitable. And so you find that there's always or let me say in the, let's say 20 years ago, there was a big push, with the liberalization of, how will I put it now? Should I call it liberalization? The Soludo years, where banks were required to recapitalize and expand, and licenses were categorized according to regional, national, and the rest of it. So the banks actually mobilized a lot of money from the capital market, and they rolled out by rolling out branches. And basically, that has been their model. So today now, from what we see, banks are closing branches down. And it's partly because of the challenge of fintechs. Now, how fintechs see the world is different. The fintech's balance sheet is centered around the customer. Everything is about the customer. And that is why for fintechs, they are very light on infrastructure. The idea is that the same infrastructure, so think of a fintech as a single branch serving the entire country. And that is the only sunk cost infrastructure or the operating costs that is serving every customer. And fintechs look at their own profitability on a per customer basis. So for them, their model is very similar to the telecommunication model. When you sell it in telecoms, when you sell a SIM card, our assumption is always, we sell you a SIM card, you use the SIM card for a while, maybe you get another SIM card from another telco, and you stop using our SIM card for some time, or you come back to it. So there's what we call a customer life cycle, which is usually in 3 stages, which is acquisition, usage, and churn. Churn is basically customers not using our service anymore. So that is how fintechs also see the world. They actually track on a per customer basis. They offer the same services that every traditional bank offers, but instead their unit of profitability is not the branch, it is the customer. So if you are recruited as a customer, there's a cost of acquiring you. It could be a marketing cost. Typically, it's a marketing cost because fintechs acquire customers digitally using digital marketing. They invest in outbound digital marketing, whether social media or direct acquisition. That's actually a topic for another, another session. They use that to recruit a customer to start using their service, and it comes at a cost. And then when you start to use the service, basically they look at how long you spend using their services before you drop off for whatever reason. And that's basically your life cycle. And I did a little bit of a model here. I believe everyone can see my screen. So I put a small example here on how typically fintechs calculate profitability. So let's assume that a fintech invested 1,000 naira in recruiting a customer. Probably he did some digital marketing, and then the cost came down to 1,000 naira per customer. Now, if that customer is using that fintech services, for the services that they are using, you earn income every month. Let's assume that hypothetically the customer is giving you 300 naira per month. That's individual customer, and that customer is on your platform or your service for 6 months. What it means is that the lifetime value of that customer is 300 naira multiplied by 6 months. That is 1,800 naira. Now, remember that we spent 1,000 naira to acquire that customer. So the profitability on that customer is essentially that lifetime value minus the acquisition cost. And that is 800 naira. And 800 naira actually represents the gross income for the fintech. And that is where it's from the gross income that you now begin to deduct all your other costs, like probably technology costs or operating costs or whatever running costs. Remember, I mentioned that fintechs operate on the one branch principle. There's no branch, or as it were, it's the same infrastructure that is serving every customer. So basically, the model of the fintech is to acquire as many customers as possible. So unlike the traditional banks that are looking for money, that's why you can't see a fintech coming to disturb you for deposits. They want you to actually use the platform to perform services, and that is how the income comes in. So now, why did I say neobanks are red ocean fintechs? Remember I said that a red ocean market is a market that is already in some sort of saturation, or it has gotten to a peak. You have a situation where you have a lot of big players who have scaled very well, and they've taken a big chunk of the market. So what it means is that the barrier to entry for that market is much higher. So it basically shuts out most new entrants. So for you to come into the market as a new entrant, it's either you have a lot of capital, or you have capital plus an innate advantage that you want to leverage. So for example, if you were a traditional bank and you wanted to launch a challenger brand that wants to challenge fintechs, then you have infrastructure, that you can leverage. So that in itself, neobanks in this sector, they have scaled. A lot of them have scaled. So you have OPay reporting almost 30 million customers now. You have Fair Money reporting about 5 million or so. You have Kuda talking about 3 million customers. These are customers that it has taken, let's say banks like Stanbic, it has taken them probably 15 years to get to 5 million customers. But Kuda is reporting it in just about 2 or 3 years. So it's already a saturated market. Then the second thing, which is an issue in this particular market, is that when you really look at the landscape of neobanks, they are aggressively competing on charges. So you find a Kuda saying zero charge. I believe they've stopped it now. They were actually allowing people to transfer for free, So basically that one has raised the barrier to entry. So for them, they are investing money. If you think about it, they are investing money in customer acquisition and they are offering services for free. If you are a new entrant, how long can you withstand that? Except you have a lot of capital. So I see this as a value destruction that is happening in the market, because essentially you are not really reducing your cost of acquisition. Cost of acquisition is a function of competition. So if you have the more players are in the market looking for the same customers, the more expensive it's going to be to acquire customers. Whether if you are talking to, let's say you are using Facebook or you are using Instagram to acquire customers, it's the same people that are on Facebook. When a single player, let's say Carbon, was targeting people on Facebook to sign up to their services, so sign up will probably be much, much easier. But when you now have about 5, 6, 7, 8, 10 players aggressively campaigning for the same customers, then the cost of acquisition is going to be higher. So, customers are likely going to take a lot more time, or they will sign up to all the services and only use one, thereby, increasing your acquisition costs. But more importantly, when you compete based on charges, to say I'm giving this for free, I'm giving that for free, you are actually doing value destruction. Then the third, neobanks are actually competing around the same set of services. Every neobank has save money, pay bills, take loans, withdraw money. It's basically, when you look at the services, they are all the same. They are all the same, which now gives rise to my theory that a lot of these fintechs, these neobanks, will now begin to encroach into the green ocean that I talked about earlier, start to offer e-commerce services, start to offer, cross-border transfers. They will have to look for new things to add to be able to increase their profitability. Now, let's talk about institutional competencies. What makes a neobank, or what will make a neobank successful? Let's say after all said and done, you still believe you want to go into red ocean or not. You believe you have what it takes to set up your own neobank. So you must have some key competency, and you must have that ability to continuously execute and improve them. Number one is technology. You must have that capacity to be able to build your own technology solution that gives you that advantage to launch the services you want to launch in the market. So this is the number one killer for businesses, especially fintechs in Nigeria. So if you don't get this technology solution right, you are not even getting out of the starting blocks. So typically most fintechs in Nigeria and elsewhere, they invest in their own technology solution, because typically traditional technology companies who build software for traditional institutions, their solutions don't work for fintechs. So those solutions are mature and they are built around the traditional banking branch-based model. So typically they will not work for a startup. They won't work out of the box, and they are also very expensive. So typically you have to put a lot of time and investment into building your own solution from the ground up. Now, there are many techniques. Unfortunately, we don't have enough time to deal with all of that today, but there are many techniques and strategies around how you achieve this. Hopefully, there might be an opportunity to return again and deal with some of these topics in detail. Then the second competency is in service branding, digital customer acquisition, and revenue growth. So you must be able to create your own brand in the market, make your own statements, and catch the attention of customers. And typically it has to be digital, because the beauty of digital marketing is that it's organic. So typically, once you're able to get your brand out there, then the target market picks it up. That is what happened to the likes of Piggyvest or Kuda or even Opay. They actually got into the digital space and owned the space as much as possible. And, they created that organic pool and people started looking for their services. Then, of course, the third one is you have to build a very strong and solid back office transaction management team, because you don't have branches, you don't have customer service. So basically, you have to have a lot of vigilance on transaction processing. Everything that you are doing, everything the customer is doing is digital. So you have to be extremely vigilant, I would say, in monitoring your transaction processing. Again, this is another very, very, it's a detailed topic that, it requires actually almost like a session on its own. And then, of course, the last but not the least is efficient capital management. You have to be really, 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 really focused on managing your capital. Now, note I didn't say your income, your capital. You have to be very efficient in managing your capital so that you can, because the whole idea of running a neobank is you must be able to scale exponentially. So you can't increasing costs can throw all your customer acquisition lifecycle management. It will impact your profitability right away. The less able you are to manage costs, the less likely you are to have a profitable business. Now, in terms of the licensing journey, I see that I have just about 5 minutes. So I'll talk a bit about licensing journey for neobanks. So I would say there are 3 stages. There's a 4th stage, but I would say stage 3 and stage 4 are more or less depending on your capitalization, your capacity, and your ambitions. It now determines the journey that you take. Like I said earlier, the first stage is to partner with an existing bank or microfinance, a traditional institution that is happy to allow you to leverage its infrastructure to build your own product. It's not going to cost you anything. There is no regulatory implication other than you having that agreement with the bank. So generally, as a fintech, you can't hold deposit unless you have a license to do banking. So what it means is that your bank partners will hold deposits for you. What this allows you to do is to launch your brand in the market and test your value proposition in your target market. So at that point in time, you have a value proposition you want to offer and you want to test it and see whether the unit economics make sense, that you are going to be profitable on this concept. So once you start with that stage, you can move to the next stage, which is you get your own license, depending on what you want to do. So typically, to do banking activities, you get a unit microfinance bank license. And if you are doing some additional lending or asset financing services, you might need to get a finance company or lending license. So that is where cost now begins to come in. It depends on the type of, I believe unit MFB starts from about 50 million, roughly can get up to 200 million, depending on the capital requirements, depending on the category that you want to play in. And, to do that, the objective for you doing that is You already understand, you defined your brand, you've launched your value proposition, your unit economics work, and you now want to find what is called product market fit. You are now sure that your product can sell in the market, and it helps you to make your own offering concrete in the market. It gives you that legitimacy, so you are not associated with another brand. You are actually known, just the same way when they talk about Kuda is a microfinance bank, and everybody knows that Kuda is Kuda Microfinance Bank. They are not associated with any other bank. And then at that point, you are ready to scale, and you're also ready to raise capital for expansion. When you've passed that stage, it's your balance sheet that will tell you that you have passed all those stages, and your growth in terms of customer acquisition. If you now want to expand beyond that level, you can decide to get a national or regional microfinance bank license. So for this, the capital requirements are quite steep, and this is important if you are beginning to look at if you want to dip into the retail market and you are no longer just online. Maybe you want to have your own agent network. You want to recruit customers on the streets like an OPay is doing, or Palm Pay or some of those guys. So those guys have mobile money licenses. So that's stage 4. So it's stage 3 and stage 4 are actually more or less the same thing, with some little bit of difference, in that with stage 4, you can actually get into payment processing. So you can offer your infrastructure, you can process your own transactions yourself. You don't need a settlement bank in the real sense of it. For microfinance banks, typically they ask you to work with a deposit money bank for your settlement processing. But in stage 4, you don't need a settlement bank. You can actually process your transactions yourself. And you are already operating in direct competition with the the big banks. So again, what are the risks? So I have just about I think my time is actually up, so I'll just take about 1 minute to talk about the risks. So like I said before,
actually,
technology. Sorry,
I say you have 2 minutes.
Sorry?
More. You still have 2 minutes.
Okay, great. So the risks are typically, number 1, technology. Like I said before, this requires, tooling yourself to be able to, you need to equip yourself to be able to actually build and maintain the technology that's going to support your business now and into the future. This is the part that most startups get wrong. So whether you are doing it in-house or you are outsourcing, there's a high risk of you making the wrong decision. And the wrong decision might cost you not just in money, but also in time. Then market approach. So the difference between traditional businesses and fintech, or traditional financial service business and fintech, is that in fintech, I would say you must find market fit within the shortest possible time. So that's where the customer life cycle is important. So for example, if it costs you too much to acquire customers, and it's difficult for you to acquire customers, and customers are not really profitable, then it's not a business. Like the customers maybe it costs you a lot of money to acquire one customer, and the customer does not generate enough income for you over the customer's tenure, then you have a problem. It means that business can never scale. So that is, in the very short term, you need to get it right. There's no long term in fintech. I must say, there's nothing like long term. Fintech businesses, you have to get it right. I would say within 6 months to a year of operating, you must be able to say, this is the working model that fits the market. Otherwise, you will need to make changes. Either you are pivoting or you are moving into changing your strategy. You can't continue with the hope that maybe the market will change. Most likely when the market changes, it's not going to change in your favor. That's more likely to be the case. And then you have to find a moat. A moat means you have to find your own unique advantage, what you are selling in the market, and then focus on stabilizing yourself in that moat and making sure that you are making money before you even try to put additional funding into the business. Then, of course, regulatory shift is a problem. As much as possible, like I said, start by leveraging partnerships, and then with the mindset that there's a particular core license that you get. Instead of trying to get every license, you don't really want to deal with too many regulators because it makes you become a traditional business, because regulatory bodies will enforce their own traditional views. So the thing about fintech is that, I mean, without prejudice to regulatory bodies, they are doing a great job. But the problem is that typically regulators they are restrictive. They don't want you to take any risks. So basically, there are quite a number of things. I remember when I was in the telco, and I moved from one telco to another telco. And in the other telco, we took a different approach to SIM registration, where we were collecting customers' biometrics. So when we register you, it was the same process where we take your SIM registration and then we provision your SIM card. Sorry, I'm going into telco language now. We activate your SIM card. And the regulator wrote us and said, who asked you to do that? That this is the process. We're now telling them that, look, we are doing it more efficiently than your regulation. The regulator said, we are going to sanction you if you don't go back. So we have to revert to an inefficient process. So that's the problem if you are over-regulated. If you have too much regulatory oversight at the early stage of your business, your growth will be affected. And then the last but not the least is the use of capital. I will still say that whatever fintech business you choose to go into, you have to plan for a runway of at least 12 months to ensure that your product gets to market. If you don't have a funding runway of 12 months, it will be very difficult for you to get your product to market. So I think for today, that is basically my submission. We talked about NeoBanks and all the characteristics around that. I'd like to thank you all once again, and I believe the floor is open now for questions. Thank you very much.
Very much, sir. Thank you so much for the session. We know the time was quite short, but I think you were able to touch a lot of items, a lot of areas. Definitely, there are more things to talk about, but we'll come to the Q&A. Before we go into Q&A, we would like to quickly take one or two agenda items. And so while we're doing that, we would like members of the audience. Yeah, you can very quickly.
So I will. So essentially, we have our own platform, which is agency as a service. So basically, we provide our own solution for agency banking. And we run our own agent network, but at the same time, we also host quite a number of super agents who are running agency banking on our platform. We also provide retail services. So whether anything that has to do with payments, collections, and agency banking in the retail sector. So that is what our platform does. And if you look at the screen, you can see. So basically, we do design and build consultancy as well for institutions, whether traditional or fintechs. We have quite a number of customers, so we can actually design. So let's assume that all you want is for us to design your product. We can do that for you, and that's on a time and material basis. We also build, we also do the engineering. We build platforms and so on and so forth, and we provide general advisory as well. So, for example, this talk that we had, we can run a full workshop for you that is much more detailed. There's only so much that you can say in 45 minutes, but we can have a detailed session where we take you through scenario planning, help you plan your journey to the market if you are looking to actually roll out a fintech service. So that's basically what we do, and that's how we play.
Thank you so much, sir. Thank you very much for that. Okay, if there is no question, I think we will move to the next item on our agenda tonight. But yes, the video recording will be available on our YouTube page. I think within 1 to 2 weeks of this session, it will be available, and we can take advantage of that. Okay. All right. Sorry, Mr. Babalola, there's a question here that is not clear. He said, not expensive. I didn't get that, sir. Mr. Akinlara, do you want to clarify that? Okay, there's a question here that says, which are the low-hanging fruits in fintech service you would recommend for a startup? Then, Mr. Akinlara, your question, if you can, you phrase it, sir. Yeah. Well, I would like to round up the Q&A within the next,
okay,
3 to 5 minutes.
Okay, can I let me answer the question about low-hanging fruits. Okay, so generally speaking, in my opinion, the lowest hanging fruits are in the retail space, and that's agency banking and merchant services. So for that, you can roll out your own fintech service, doing collections, helping with payments. There's still a lot of opportunity there. The biggest players, there's no financial institution in Nigeria that has up to 1 million agents or merchants that are doing payments and collections out there in the field. So up till now, cash still remains about 90% of transactions on the street. So it's part of what I listed as the green ocean, because even though you have big players like the Money Points and the OPay and the rest there's still a lot of opportunity for a startup to play with a bit of capital and a relatively short time to market. So you can use that to get your feet wet and understand the business while you are thinking about how to leverage on what you have for consumer services. So in my opinion, that would be the lowest hanging fruit in the industry right now. Then the other question, hope not too expensive. I guess that refers to our services at UCAD. It depends. Yes, can anyone hear me? Deji, are you able to hear me?
Yes, sir. Please go ahead, sir.
Okay, yes. I was responding to Mr. Babalola's comment about our services not being too expensive. Actually, for UCAD, we actually focus on giving you the solutions at a much better pricing than the market. So it's actually one of our USPs to get you to market cheaper and quicker than anybody else. So definitely, I would say yes, not too expensive at all.
Okay, one final question. We're running out of time very quickly. So Mr. Yoashalu says, is there any insight on lending platforms?
All right. So,
and then okay, please, if you can take this together, and this is the last. It says, please, can you clarify the difference between PSB and agency banking?
Okay. Well, so let me start from the first question, which is insight on lending platforms. So, lending is actually part of the red ocean. Like everybody's offering lending. So when you say platform, I guess you are talking about the technology. So basically, nowadays there are actually platforms like Lydia and Lend Square which actually offers any startup the ability to launch their own lending services. So Lydia is L-I-D-Y-A, L-I-D-Y-A. So you can look into that, and then Lend Square is also another platform. So just like what UCAD is doing for agency banking, these two startups are doing that for, or these two platforms are doing that for lending. So, lending is also a high traction service. It's also a red ocean service for me. So basically, if you get into lending, you are competing with anybody and everybody. But generally, the starting point is what's the cost of getting into the market? And I believe once you latch onto any of these platforms, it's a very good starting point. Most of them actually they've curated a journey for you on how to get there. The next question is difference between PSB and agency banking. So PSB means Payment Service Bank. So they are it's a bank that is focused on payments. So they can offer any type of payment services. So basically they combine, if I go back to my presentation, it combines the ability to offer neobank services and to also be a payment processor. So basically I would say that's what the telcos are now doing, even though their offering is not yet so mature. But you are supposed to actually in fact, it's a service where you have to invest heavily in technology and invest heavily in your own capacity. And I think for the license, it's about 5 billion. That's the capital requirement from the CBN. For agency banking, is basically, that's what you call the POS agents on the street. So you can basically be an agent, not necessarily of any bank, but you provide payment and banking services. And what happens is you recruit agents onto your platform and you provide them the tools for them to interact with retail customers who want to make payments, who want to transfer money, withdraw cash, and the rest of it. In fact, for that is one of those services where you don't really need a license to start. You can start by partnering with a licensed bank, and then you become, their agency channel partner. And as you grow, you can apply for a super agent license, which the capital requirement is just 50 million naira. So that's the difference. So the difference is 5 billion, 50 million, just humorously speaking.
Thank you so much, Mr. Jide. We really appreciate you. Thanks for the insights and the passion and your time. We believe God will bless you abundantly. We pray God blesses you abundantly in the name of Jesus. Thank you so much. And I'd like to thank everyone that stayed on the call.